All right. So now we're going to talk about the measurement elements of IND AS 37 in relation to provisions and contingent liabilities and contingent assets. So whenever you think about a measurement, so we talked about the recognition, now we get to the measurement. So best estimate is what we need to make, factoring in the risk and uncertainties, and also the present value. There are a number of areas wherever we need to make a payment which goes beyond a year or going to receive something goes beyond 12 months. Ordinarily, it will require us to discount it to present value, factoring in the present future events with an expected disposal of assets. All of that is what we're going to talk about, which we need to budget in, factor in while we're looking at the measurement principles. So what's the meaning of best estimate, right? So again, it's accounting, as you know, is a subject matter of an estimate. The number of areas where we need to make an estimate, for example, depreciation is nothing but an estimate. So for all provisions, we'll have to make an estimate, and there could be basically two potential methods through which we do it, which is a expected value outcome or the most likely outcome. And we're going to talk about that. So amount recognized as provision for the expenditure required to settle the present obligation. The estimate of the amount that an entity would rationally pay to settle or transfer the obligation give the best estimate of the expenditure. And estimates of outcome and financial effects are determined by judgment. There's a high degree of judgment which is involved, right? And hence a lot of disclosure supplemented by experience of similar transaction, and in some cases reports from independent expert. Also, many times you may need to take a legal expert's opinion or other experts in that sense. So again, best estimate is something which is an area of judgment, and you will know based on your historical experience what this type of transaction, what this type of exposure, what is a likely outflow or what's the likely inflow. It is in a way relevant from both perspectives. Let's take an example. Kaveri Limited sells its goods to its customer with a warranty. The warranty covers the cost of repair of any manufacturing defect that become apparent within the first 3 months from the date of sale. In all the goods that are sold by Kaveri Limited, if the defect is minor, then a repair cost of INR 5 lakh would be incurred. And if the defect is major, then a repair cost of INR 20 lakh would be incurred. The company past experience and future expectation indicate that for the coming year, 70% of the goods sold will have no defect, 20% of the goods sold will have minor defects, and 10% of the goods sold will have major defects. So 70% will have no defects, 20% will have minor, and 10% will have major. And the cost of defects for minor is 5 lakh and for major is 10 lakh rupees. In accordance with the standard, you're required to assess the probability of an outflow for the warranty obligation as a whole for Kaveri Limited. So we don't have here data to number of units which are being sold. So if you look at, let's say, assuming 1 unit is being sold, right? So essentially what we're saying that 70% possibility is 0. There's a 20% possibility of 5 lakh, which results into a 1 lakh potential outflow, and there is a 10% possibility of 10 lakh, 10% possibility of 20 lakh is the potential liability which I may have, that is like 2 lakh. So I have to make a total liability, total provision of 3 lakh rupees per unit of this product being sold. So if I've sold 100 units during the period, that means I have to make a liability of 3 crores. If I've sold only one, I have to carry a liability of 3 lakh rupees. That's how you try to make a best estimate of your liability. Expected value of the cost of repair is 70% nil, 20% for 5 lakh, 10% for 20 lakh is 3 lakhs. So assuming if you have 100 units, it's 3 crores. And if you look at the other way around, right? Let's say you have 100 units, right? And you try and do the math other way around. So 100 units, 20%, that is for 20 units, right? I'm going to make 5 lakh, that is 1 crore. And for 10 units, right, I'm going to make a provision of 20 lakh, which is 2 crores. So that's liability of 3 crores. So both way, you will get the same answer. So we're going to factor in the risk and uncertainties as you are looking at to provide for best estimate, right? So risk is nothing but variability of outcome that may increase or decrease the amount at which the liability is measured. So you got to factor in the possibility of an outcome, range of outcomes. All of that is what we need to look at. Caution is needed in making judgment under condition of uncertainty so that income or assets are not overstated or understated, right? Risk adjustment can be accounted for in number of ways, such as adding to the expected present value of future outflow, adjusting the estimate of future outflow, or adjusting the discount rates. All the assumption. Essentially, what is risk adjustment? Nothing but, you try to play with the assumptions. You try to play with the assumptions, and then as a result of by you changing the assumption, you alter the amount of provision which is required to be made. Disclosure of the uncertainty surrounding the amount of the expenditure should be made. So what's the present? How do you compute the present value? You again look at the discount rate, the incremental rate of borrowing without adjusting it for tax, where the effect of the time value of money is material, which is where it goes beyond 12 months, shall be the present value of the expenditure expected to require to settle the obligation. It should be the present value of the obligation, right? The discount rate shall be a pre-tax rate that reflects current market assessment of the time value of money and risk, which is specific to the liability. There are two approaches: expected value outcome, right? Expected value method, where there are range of possible. They're calculated how? You look at a range of possible outcome, right? There's range of possible outcome. Each outcome is discounted to its present value, and then you assign the probability, okay, to each of these outcome, and then you get to a common number. There is a most likely. So this is method number one. This is method number two. The most likely method. There's only one outcome in a most likely method, and that becomes the basis of your provision. And we see again both the possibilities exist depending upon the type of issue you are dealing with. Let's take an example. Entity X has entered into a lease for a warehouse. The lease permits the entity to build a mezzanine floor and partition the building for offices at a cost of INR 15 lakhs, right? At a cost of INR 15 lakh. The lease is for a period of 15 years and specifies that the property must be returned to the lessor in its original condition. Okay, the lease is for a period of 15 years and specifies that the property must be returned to the lessor in its original condition. The entity estimates that the present value of the cost of removing the improvement is INR 5 lakh. That's like the best estimate I have is 5 lakh. That's the most likely amount. That's the only estimate I have. So you're required to determine how we should account for this obligation, right? So it's like a leasehold improvement. I'm going to capitalize the leasehold improvement under IND AS 16, right? Or I have to look at IND AS 116 as well. So I'm going to capitalize the leasehold improvement of INR 15 lakh and amortize them over the term of the lease under IND AS 16, right? Under IND AS 116. The entity has a present obligation, right? The entity has a present obligation under the lease to remove the improvement at the end of the lease term. The obligation is arising when the entity completes its improvement, right? So, which is the past events. So the present value of 5 lakh should be recognized when the improvements are completed. Amount either be recognized as part of the right of use asset under IND AS 116 or as part of the leasehold improvement asset under IND AS 16. Okay. Yeah, I think. Okay. Under IND AS 16 or under IND AS 116. You also may need to factor in the future events that may affect the amount required to settle an obligation, shall be reflected. But it's always very, very difficult. It's always very, very difficult in practice. So theoretically, it's possible, but it's very, very difficult. We'll try and see an example where it is reasonably good and possible to do so, actually. May be particularly important in measuring provision, may believe that the cost of cleaning up a site at the end of its life will be reduced by future changes in technology, though very, very difficult in real life. The effect of possible new legislation is taken into consideration in measuring an existing obligation. when sufficient objective evidence exists that the legislation is virtually certain to be enacted. Let's take this example. Godavari Limited is operating in petrochemical. Over the last 30 years of operation, the company has caused environmental damage by dumping waste and polluting the river near its factory. In absence of environmental legislation requiring cleaning up the waste, the company does not clean up the river. As at March 31st, 2019, the state government has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated. The formal gadget notification of the law is pending. You are required to determine how should Godavari Limited deal with this situation. You have to obviously provide for it because now a law is coming and it's all arising out of past events. So there is going to be an obligation, though the law is yet to be passed, but there is a high degree of possibility that this law will be passed. And if you can make a reliable estimate of the amount of outflow, you are required to make a provision. So the obligating event is the contamination of water because of the virtual certainty of the legislation requiring cleaning up and outflow of resources is certain. Also, there is a present obligation. If it is possible to arrive at best estimated cost for the cleanup activity, then Godavari Limited should recognize a provision in the books of account for 2018-19. Expected disposal of asset, they are not allowed to be factored in, right? Gains from the expected disposal of asset shall not be taken into account because that's a future event. Unlike in a way, when you provided a loan to somebody and you've taken a collateral, while you're making an estimate loss, you of course factor in the value of the collateral, right? Subject your ability to take the possession and then your ability to dispose and so on and so forth. But here in this case, in if expected disposal of asset in relation to provisions, you're not allowed to factor in. Gains on the expected disposal of assets shall not be taken into account in measuring a provision, even if the expected disposal is closely linked to the event giving rise to the provision. Okay. Instead, an entity should recognize gains on expected disposal of asset at the time specified with the standard dealing with the asset concerned. So under IND AS 37, you're not allowed to do it. If it is any other standard, good luck to you and then do it. So we could recap what we've been talking so far, right? Best estimate. Provision is recognized for the best estimate. You got to factor in the risk and uncertainties, right? You got to look at the present value if it goes beyond a year, right? And you factor in the future event like possible legislations, all of that, and then expected disposal of asset is not to be considered while making a provision. So I think we've talked a whole lot about your provisions, contingent liabilities, and contingent assets. We talked about what is a provision. We talked about the best estimate. We talked about what's a contingent liability. We talked about a contingent asset. We talked about the range of possibilities, right, of what is being defined as virtually certain or a probable or a possible or a remote kind of a possibility. Asset you record, a contingent asset you record is a virtually certain, otherwise you do disclosure, whereas the liability you record when it is probable, which is more likely than not. And we talked about the best estimate, and we talked about the expected value outcome and the most likely outcome and expected value, their range of possibilities, range of cash flows. You do the discounting, you do the assignment of the probabilities, and then you get to an amount which should be carrying forward in your balance sheet. A most likely amount is like a single amount, which is based on best possible information at that given point in time. And then we talked about the discounting, so on and so forth. So all of that is great. From a principal perspective, you guys just should be very clear in your mind that, what is the meaning of a provision? Something which is arising out of a past event, right? Resulting into a present obligation, right? Where the outflow is probable, right? Outflow is probable and you cannot exit out of that situation like an onerous contract we talked about, all of that. Awesome. Okay. So now we're going to focus on few other areas. Okay. Few other areas. Other areas like reimbursement. Okay. So how do you deal with reimbursement? Where some or all of the expenditure is required to settle a provision is expected to be reimbursed by another party. You got to make an evaluation. Are you the principal? Are you the agent? The reimbursement shall be recognized when and only when it is virtually certain that reimbursement shall be received if the entity settles the obligation. The reimbursement shall be treated as a separate asset. The amount recognized for the reimbursement shall not exceed the amount of the expenditure or amount of the provision. In the statement of the profit and loss, the expense relating to provision may be presented net of the amount recognized for a reimbursement. This require more evaluation depending upon the fact pattern. Let's take an example. RAM Limited is a manufacturer and distributor of mobile phone brand B1. RAM Limited gets its handset manufactured by Sham Limited. As part of the arrangement, RAM Limited has an enforceable agreement with Sham Limited that in the event of the company becoming liable for any damage claims from its customer due to malfunctioning of its handset, then 40% will be reimbursed by Sham Limited. During the financial year 18-19, a claim of INR 10 lakh becomes payable to customers by RAM Limited. That means I have a right to claim reimbursement up to 4 lakh. You are required to determine how should RAM Limited account for the claim that becomes payable. So essentially, I have to record a liability, a provision, I have to record a receivable of 4 lakh because it is reasonably certain that I'm going to receive. I have a contractual right to receive this. And then the question is, how do I present this in the P&L? And depending upon the arrangement, I may, most likely I may do a net presentation. Since the understanding result in enforceable agreement, the reimbursement of INR 4 lakhs will be recognized as a reimbursement right and provision will be recognized for INR 10 lakh rupees. In the statement of financial position, the reimbursement right shall be treated as a separate asset and shall not be offset with the provision. In the statement of profit and loss, the expense may be presented as INR 6 lakh after offsetting the reimbursement right. Changes in provision. If there are changes in provision, how do you deal with that? Changes in provision are again change in accounting estimate. Change in accounting estimates are dealt on a prospective basis. Okay. A change in provision shall be reviewed at the end of each reporting period and adjusted to reflect the current best estimate. If it is no longer probable that an outflow of resources embodying economic benefits will be required to settle the obligation, the provision shall be reversed, right? Now, where discounting is used, then we need to keep on unwinding the carrying value to continue to record the continue to increase to the present value. The carrying amount of a provision increases each period to reflect the passage of time. This increase is recognized as borrowing cost. Awesome. So if you're doing a discounting, right, the unwinding, so to say, so it's very simple example. Let's say a total outflow was 100 after 3 years, right? Hypothetically speaking, that let's say the present value is 70. So now in year 1, let's say 7 is the interest. So in year 1, my liability will become 77. Okay. This 7 we are saying is nothing but the borrowing cost, which gets recorded like an interest cost in the P&L. Awesome. Let's take an example here. Buildup Limited is a construction company. It has an income tax litigation pending before the appellate authorities. The legal advisor opinion is that Buildup Limited will mostly lose the case and estimate that liability of INR 50 lakh may arise in 2 years. The liability is recognized on a discounted basis. The discount rate at which the liability has been discounted is 10%, and it is assumed that the discounted does not change over the period of 2 years. Now you're required to determine how should Buildup Limited calculate the amount of borrowing cost. So 50 lakh to be discounted for 2 years, and then again you're going to follow the EIR method, effective interest rate method. So let's quickly look at the solution here. The discount factor of 10% for 2 years is 0.827. Buildup Limited will initially recognize provision for INR 41 lakh 35,000, 50 lakh into 0.827. And the discount factor of 10% at the end of year 1 is 0.909. At the end of year 1, the provision amount would be INR 45 lakh 45,000, right? As per the standard, the difference between the two present value, which is 4,10,000, which is 45,45,000 minus 41,35,000 is recognized as interest cost in year one. At the end of the year two, the liability would be INR 50 lakhs, and then the incremental interest cost of 4,55,000 will be recorded. So we're now going to look at a case study adapted from 2018, which was there for 4 marks. Sun Limited has entered into a binding agreement with Moon Limited to buy a custom-made machine for INR 4 lakh. At the end of 2017-18, before delivery of the machine, Sun Limited had to change its method of production. Okay. The new method will not require the machine ordered, which is to be scrapped, after delivery. The expected scrap value is nil. Given that the asset is yet to be delivered, should any liability be recognized for the potential loss? If so, give reasons for the same, the amount of liability, as well as the accounting entry. So essentially, I ordered for a machine which was to be costed me 4 lakh rupees. Now I realize at the end of 2017-18, I realize that I have to change my own method of production, as a result of which the new method will not require this machine, which I need to scrap. The expected scrap value is nil. Okay. Now the asset is yet to be delivered. Should any liability be recognized for the potential loss? Okay. So you entered into a contract to acquire an asset of which it has no value. So what does that mean? So do I need to provide for this, right? So let's look at the solution. Executory contracts are contracts under which neither party has performed any of its obligation, or both parties have partially performed their obligation. The contract entered by Sun Limited is an executory contract, since the delivery has not yet taken place. But you got to also evaluate it. Does it become an onerous contract, right? Only if they are onerous. Defines an onerous contract as a contract in which the unavoidable cost of meeting the obligation under the contract exceeds the economic benefit expected to be received under it. As per the fact, Sun Limited will not require the machine ordered. However, since it is a binding agreement, the agreement entity cannot exit out of this arrangement. Further, if I were to scrap this, I won't get anything out of this, right? So essentially, what do I need to do? The 4 lakh rupees, which is becoming actually an onerous cost, right? So the entire 4 lakh is what I need to provide for. So I'm going to record these entries. Onerous contract provision expense account to provision for onerous contract. Once I receive this, P&L debit, and then I'm going to credit onerous contract provision account, right? And then of course there could be some cash entries as well, depending upon, once you've taken the delivery, you got to make the payments. It's like an onerous contract. All right. So let's look at some elements around restructuring cost. Restructuring provision require a detailed formal plan or binding sale agreement. So you are entering into a restructuring arrangement. So what's the just by somebody saying I want to restructure means nothing, right? So it has to be a formal plan or approved by the board. Okay. Then entity must illustrate a demonstrable commitment by either communicating the plan or start to implementing the plan, announcing its main feature or start to implement the plan. Time, right? Again, you got to begin and in a time frame that makes significant changes unlikely. A board decision alone is not sufficient. You've got to demonstrate that all the elements of the plan are now in place, and a desire to implement, which in a way can be demonstrated by communicating to the parties, those who are going to get impacted because of the plan. So when do I record the restructuring cost? Details of a restructuring plan, right? Business or part of a business concern. There's a principal location, the function and number of employees, expenditure undertaking. So all of these elements are supposed to be addressed in a restructuring plan. Okay. Now, if all of these elements are in a way addressed in a restructuring plan, and so what is to be included and not included, necessarily entailed by the restructuring, not associated with the ongoing activities. Not included is marketing, retraining or relocating continuing staff, etc. So the whole idea is that what is it I can provide for as and when the restructuring plan is in place, right? Let's look at an example. No implementation before end of the reporting period. Hard Luck Limited Board of Directors has decided to close down a unit on 8th of March 2018. On 8th of March 2018. The decision of the board was not communicated to any of those affected. Neither any steps has been taken to implement the decision before the end of the reporting period, that is March 31st, 2018. It is assumed that a reliable estimate can be made of any outflows expected. Present obligation as a result of a past obligation. There has been no present obligation and hence there is no obligation. No provision is recognized. Impairment testing is required to be done as per IND AS 36, impairment of asset. So no provision unless you start communicating, start implementing, etc. from that perspective. Even though you may have decided, even though you know that how much I'm going to spend, right? Doesn't result into a present obligation. Let's look at another scenario, communication implementation before end of the reporting period. So same example, on 8th March, decide to close down. On 15th March, detailed plan for the closure was agreed by the board. Letters were sent to customers, warning them to seek an alternative source of supply. Redundancy notices were sent to the staff of the unit. It is assumed that a reliable estimate can be made of any outflows expected, like number of employees expected to become redundant and compensation payable on redundancy can be measured reliably. The obligating event is the communication of the decision to the customer and employee, which gives rise to a constructive obligation from that day because it creates a valid expectation that the unit will be closed. You got to then provide for the restructuring cost. That's the distinction between the two. Right, between the two scenarios. In one scenario where you've not communicated, the other scenario, now you've communicated addressing all different elements of the plan, right? Then you got to provide for this. Disclosures, disclose, and disclose. The carrying amount at the beginning and end of the year, each type of provision disclosed at the beginning, additional provisions, amount used, unused amount reversed during the period, increase during the period in the discounted amount using from the passage of time, and the effect of any change in the discount rate. All of that comparative information is not required to be disclosed. Entity should disclose the following for each class of provision: brief description, nature, timing, amount, uncertainties, detailed roll forward, expected and recognized reimbursement relating to provisions. All of that is what I'm required to disclose. To recap what all we've in a way talked about, reimbursement right is a separate asset, possibly in the P&L. We can look at on a net presentation. If there are changes in provision, is a change in estimate to be applied on a prospective basis. If it is no more probable, then we got to reverse the provision. If the restructuring provision, you only provide for it when the plans are in place, communications being made, and there is no going back on what you committed to spend. The disclosures, please disclose, descriptions, roll forward, and financial effects. Key differences between IND AS 37 and AS 29. One is I talked about constructive obligations, right? Constructive obligation and change in the definition of provision. So AS 29 required creation of provision as a result of normal business practice, custom, and desire to maintain good business relation or act in an equitable manner. IND AS 37 require creation of provision respect of constructive obligation. So that's one, in a way, it is different than legal obligation. So legal obligation, anyway, we need to make. Discounting is also required under IND AS 37. Discounting is not permitted under AS 29, except for decommissioning, restoration, and other similar liabilities associated with property, plant, and equipment. Some of the other key differences: contingent asset, we talked about, virtually certain but disclosed under IND AS 37 are neither recognized nor disclosed under AS 29. Onerous contract, you got to provide for an onerous contract. An entity should recognize any impairment loss under IND AS 36. There is no specific provision in the existing standard. If there are future operating losses, you can't unless it is an onerous contract. No provision is to be made for identifiable future operating losses up to the date of restructuring, except losses relating to onerous contract. AS 29 also states that no provision is to be made for identifiable future losses up to the date of restructuring. Slightly silent on onerous contract. We're now going to look at a few more questions, which will just give you a little bit more practice. But then the key for you is to do as many practical questions, as many examples, and we're also going to provide you with a lot of case studies across range of topics. So make sure that you look at all of this. Make sure you look at all your examination past questions. Make sure you look at all the scenarios which are there in the study material. So this is what will help you clear your principle, right? In terms of how to apply all of this in an examination setting, or otherwise as well, right? So during the year 2018-19, X Limited, which is involved in nuclear activities, recognizes a provision for decommissioning cost of INR 15 crores. Okay. The provision is based on the assumption that decommissioning will take place in 80 years' time. However, there is a possibility that it will not take place until 120 years' time, in which case the present value of the cost will be significantly reduced. Assume that discount rate is 2%. Discount rate of 2% is relevant for X Limited. Discount factor at 2% for 40 years is 0.4529. You are required to draft a note for X Limited. So we are required to draft a note for X Limited. Pretty unique situation, right? 15 crore. If it is 80 years, there's a possibility it will not take place until 120 years. The present value cost will decrease. Assume that the discount rate of 2% is relevant for X Limited. Discount rate factor at 2% for 40 years is 0.4529. So essentially this 15 crore will further come down, right? By to what, 7 crores, right? So you are required to draft a note. Now, a provision for decommissioning cost has been recognized for 15 crore. The cost is expected to be 80 years. However, there's a possibility if the costs were measured based on the expectation that they would not be incurred for 120 years, the provision would be reduced to 6.8 crores, which is nothing but 15 in 15 crore, 15 multiplied by 0. What was that? Discounting factor, that was 0.4529, right? 0.4529. So that gets you to 6.8 crore. The provision has been estimated using existing technology at current prices, right? That's how you've done this. Okay. Question 2, Good Wash Limited, a washing machine dealer, offers to its customer a scheme whereby it offers to buy back the washing machine at a fixed price after a period of 4 years. The fixed price is expected to be less than the fair value of the washing machine at the end of 4 years. The credit provided to customers will be required to be used for buying a new washing machine. That is, new washing machine will be sold at a discounted price. Past experience indicate that customer generally opts for this scheme. You are required to determine whether Good Wash should recognize any provision at the time of sale of first washing machine to its customers. Right? So essentially, I am under an obligation to buy back the machine, right? When I'm going to buy back the machine, I'm going to buy it back at less than the fair value, but I'm also providing the credit, right? New machine will be sold at a discounted price. I'm selling itself this at a discounted price, right? And then I'm buying that at a high, expected to be less than the fair value of the washing machine at the end of the 4 years. Of course, we got to make something out of this. Let's look at the solution. A provision shall be recognized when entity has a present obligation as a result of a past event. It is probable that an outflow of future resources, embodying economic benefits will be required. A reliable estimate can be made. In the current case, assuming Good Wash recognize the entire revenue on the sale of first washing machine, a provision for expected cost of meeting the obligation of selling the second machine at a discounted price should be recognized, because sale of first washing machine is the past event. Moreover, past experience indicate that customer generally opt for this scheme. Therefore, probability of future outflow is more likely than not. Since it is a normal practice which the company follows, reliable estimate of the timing meeting the obligation can also be. Let's look at another example. During the financial year 2018-19, the Income Tax Authority sent a scrutiny assessment notice to Mark Limited, which is operating in the software industry. Okay. The notice is issued under Section 143(2) of the Income Tax Act 1961 in respect of the return filed under Section 139 of this Act for previous years 2017-18, assessment year 18-19, and initiated assessment proceedings on account of a deduction which in the view of the authorities was inadmissible and claimed by the company in the filed returns. During the financial year 18-19, the assessment proceedings were completed and the assessing officer did not allow the reduction and raised a demand of INR 5 crores against the company. The company contested such levy and filed an appeal with the appellate authority. At the end of year 19, the appeal is pending to be heard. The company is now not confident on winning the appeal. However, the legal counsel had advised the company that on a similar matter, two appellate authorities of different jurisdiction had given conflicting judgment, one in favor of the assessee and the one against the assessee. The legal counsel further state that it had more than 50% chance of winning the appeal. More than 50% chance of winning the appeal. You are required to advise how Mark Limited should account this transaction in the FY 18-19. Interesting question. So counsel advises that there's a more than 50% chance that I'm going to win the appeal. That means I don't have to pay this money. That means it is not probable that there will be an outflow of resources. That means this doesn't fit the bill, right? Let's look at the answer. In rare cases, when it is not clear whether there is a present obligation, for example, in lawsuit, it may be disputed either whether certain events have occurred or whether those events result into a present obligation. An entity should determine whether a present obligation exists at the end of the reporting period by taking into account all available evidence. For the example, the opinion of expert. The company is not confident whether it will win the appeal. By taking into account it is not sure whether the company would win the appeal, more likely than not, the present exists at the end of the reporting period. I think we have to revisit this answer. On the basis of such facts, it is more likely than not that a present obligation exists. Therefore, the Mark Limited should recognize a provision of INR 5 crores. We will revisit this. Okay. All right. So we've talked about provisions, contingent liabilities, and contingent assets, the measurement, a lot of other elements, and in a way, so what we're going to, in a way, and there will be a number of examples, right, which we talked about. So I'm hoping that all of these have helped you in terms of your understanding. As I said, that you should practice more and more scenarios and related answer. We're going to provide you with all of that. Wish you all the best. Thank you.